In this video, I would like to demonstrate how you prepare the journal entries and make the calculations when you have a revision in the depreciation estimate a company is using. Here we have Bloom Company. Assume that they purchased a new machine January 1st, 2028 for $80,000. The machine has an estimated useful life of 9 years. Residual value, which you remember is the same thing as salvage value, is $8,000. Bloom has chosen to use the straight line method of depreciation. On January 1st, 2031, so that's 3 years later, Bloom discovered that due to the invention of new technology, their machine will only have a total useful life of 7 years rather than the original estimate of 9. And that at the end of 7 years now, the residual value is only to be $2,000. So let's get started. We're to compute the depreciation expense amounts for the years 2028 and then 2031, which is when the revision needs to take place. So initially, remember we're using straight line, so we have cost minus the salvage value divided by estimated useful life. 80,000 minus 8,000, divide that by 9, so 72,000 divided by 9 is 8,000. Same entry, depreciation expense using the same accounts. Depreciation expense would be debited for 8,000, accumulated depreciation would be credited for $8,000. That same journal entry would have been made for 2028, 2029, 2030. So if you see on the screen now that $8,000 added together, we would have an accumulated depreciation of $24,000 at that point. And so we need that number now for 2031 because we need to recalculate based on new estimates. So now we were told that instead of 9 years, the total time is 7 years, and residual value is not going to be 8,000, but it's going to be 2,000. So let's look at that recalculation now. Balance in the accumulated depreciation account was 24,000, and the actual equipment was 80,000. So let's just do that math. So 80,000 minus the accumulated depreciation that has been booked on that asset is 24,000. So as of right now, the book value is $56,000 on this particular asset that's on January 1st, 2031. That's where we need to work from for our new calculation. And so here is the new calculation. $56,000 minus $2,000, which is the new salvage value or residual value. And then we want to divide it by a total of, we have a total life of 7 years. We're this is a re-estimation. And 3 years have already been taken, 28, 29, and 30. So we have only 4 years left to absorb the rest of this depreciation. So 54,000 divided by 4,000 is 13,000. Depreciation expense, 13,500. Accumulated depreciation, 13,500. So this is for a 1 year, right? So if the company wants to break that down over months, then they would take this 13,500 and divide it across 12 months. So here's our full depreciation schedule for this particular asset so that you can see it all the way through. So first we have depreciation expense of $8,000 we calculated for 2028, 2029, 2030. And at the end of that period, $24,000 in total accumulated depreciation would result, carrying a book value of $56,000. Next, we recalculated for 2031. So 2031 to should be 2033, and then next 2034 would each of these years would be 13,500. So just adding to the accumulated depreciation each time. And remember, we have a total of 7 years, 7 complete years now instead of the 9. And our residual value being carried on the books now, $2,000. And that was a part of the revision. We wanted to have that showing a residual value of $2,000 at the end of its useful